Welcome to our guide on investing. Today, we'll break down the essentials you need to know to start your investment journey. Whether you're starting with $100 or $10,000, the principles are the same. We'll cover the basics of different asset classes, risk management, and how to make your money work for you. The goal here is to empower you to take control of your financial future. Investing can seem intimidating, but it doesn't have to be. We'll break down complex topics into easy-to-understand concepts, giving you the confidence to start building wealth today. Remember, the earlier you start investing, the more time your money has to grow. So let's dive in and explore the exciting world of investing together. Let's start with stocks, one of the most well-known investment options. Stocks represent ownership in a company, and they can be a powerful tool for building wealth. When you buy a stock, you're essentially buying a small piece of ownership in a company. This means you have a claim on part of the company's assets and earnings. It's like owning a tiny slice of your favorite pizza place, except instead of getting free pizza, you get the potential for profit. The more shares you own, the larger your slice of the pie. There are two main ways you can make money from stocks: price appreciation and dividends. Price appreciation occurs when the value of the stock increases over time. Price appreciation is when the value of the stock goes up. For example, if you buy a share of company XYZ for $50, and a year later it's worth $75, you've made a profit. Let's say you buy a share of company XYZ for $50, and a year later it's worth $75. That's a $25 profit. That's a $25 profit. This increase in value can be a significant source of income for investors, especially over the long term. Dividends are like bonuses paid out to shareholders from the company's profits. These payments can provide a steady income stream, especially if you own shares in companies that consistently perform well. Not all companies pay dividends, but those that do typically distribute them quarterly. This means you could receive payments 4 times a year, adding to your overall returns. It's like getting a little thank you payment for being a part owner. These dividends can be reinvested to buy more shares, further compounding your investment. Now, investing in individual stocks can be risky. The stock market can be volatile and prices can fluctuate widely in a short period. It's like putting all your eggs in one basket. If that company doesn't perform well, you could lose money. This is why it's crucial to understand the risks involved. If that company doesn't perform well, you could lose money. Market downturns, poor company performance, or economic factors can all impact stock prices negatively. That's why diversification is key. By spreading your investments across different companies, industries, and asset classes, you can reduce your risk. Diversification means spreading your investments across different companies, industries, and asset classes. This way, if one investment performs poorly, others may perform well, balancing out your overall portfolio. Think of it like having a well-balanced breakfast. You wouldn't just eat cereal every day, right? You'd mix it up with eggs, fruit, and other nutritious options. You wouldn't just eat cereal every day, right? You'd mix it up with eggs, fruit, and other nutritious options. This variety ensures you get all the nutrients you need. You'd mix it up with eggs, fruit, and other nutritious options. Similarly, a diversified investment portfolio can provide a balance of risk and reward. Investing in stocks can be a great way to grow your wealth over the long term, but it's important to do your research, understand the risks, and diversify your portfolio. By taking these steps, you can make informed decisions and increase your chances of financial success. Now let's move on to bonds. Bonds are a fundamental part of the financial world and offer a different approach to investing compared to stocks. Bonds are a bit different from stocks. While stocks represent ownership in a company, bonds are more about lending. Instead of owning a piece of a company, when you buy a bond, you're essentially lending money to a corporation or government. This makes bonds a form of debt investment. Think of it like giving your friend a loan. You provide the money they need and they promise to pay you back with interest. You agree on an interest rate and a repayment period. This agreement is formalized in a bond contract, which outlines all the terms. They use your money for a while and in return, they pay you interest on the loan. This interest is typically paid at regular intervals such as semi-annually or annually. Bonds are considered less risky than stocks because they offer a fixed income stream. This predictability is one of the main attractions of bonds. You know exactly how much interest you'll be earning and when you'll be getting your principal back. This can be particularly appealing for those looking for steady income. However, this lower risk also means potentially lower returns compared to stocks. Stocks can offer higher returns but come with greater volatility. It's like choosing between a savings account and a high-growth investment. The savings account is safer, but might not grow your money as quickly. The savings account is safer, but might not grow your money as quickly. Similarly, bonds provide safety, but with limited growth potential. Bonds are often used to balance out the risk in a portfolio. By including bonds, investors can reduce the overall volatility of their investments. They can provide stability and income, especially during times when the stock market is volatile. This makes them a valuable component of a diversified investment strategy. Just like with stocks, diversification is important with bonds. Spreading your investments across different bonds can help manage risk. Don't put all your eggs in one basket. Diversifying your bond investments can protect you from the risk of any single bond issuer defaulting. Spread your investments across different types of bonds, maturities, and issuers. This way you can create a balanced and resilient portfolio that can weather various market conditions. Let's talk about real estate, a tangible asset that's been a popular investment for generations. Real estate offers a unique combination of stability and potential for growth, making it an attractive option for many investors. Unlike stocks or bonds, real estate is a physical asset that you can see and touch, which can provide a sense of security and control. When you invest in real estate, you're buying a physical property, like a house, apartment building, or commercial space. Each type of property comes with its own set of opportunities and challenges. Residential properties, for example, can provide a steady stream of rental income, while commercial properties might offer higher returns, but require more management. One way to make money in real estate is through rental income. By renting out your property, you can generate a consistent cash flow that can help cover your mortgage and other expenses. This can be particularly beneficial in areas with high demand for rental properties. You become a landlord, collecting rent from tenants who live in your property. This role comes with responsibilities, such as maintaining the property and addressing tenant concerns, but it can also be rewarding as you build relationships and provide housing for others. It's like having a side hustle that generates passive income. Over time, this income can add up, providing you with financial stability and the potential to reinvest in additional properties. Another way to profit from real estate is through appreciation. As the value of your property increases over time, you can build equity, which can be leveraged for future investments or used to improve your financial situation. As the value of your property goes up over time, you can benefit from the increased equity. This can be particularly advantageous in growing markets where property values are rising rapidly. You can sell it for a profit. Timing the market and understanding local trends can help you maximize your returns when you decide to sell. It's like buying a vintage car and watching its value increase as it becomes a collector's item. Just as with classic cars, the condition and location of your property can significantly impact its appreciation potential. Real estate can be a great way to diversify your portfolio and hedge against inflation. By including real estate in your investment mix, you can reduce risk and increase the potential for long-term gains. However, it's important to remember that it's not a get-rich-quick scheme. Real estate investing requires careful planning, research, and a willingness to navigate the ups and downs of the market. It requires capital, research, and sometimes a bit of patience. Understanding the local market, property values, and potential rental income are crucial steps in making informed investment decisions. You'll need to factor in expenses like property taxes, insurance, maintenance, and potential vacancies. These costs can add up, so it's important to budget accordingly and have a financial cushion. But with the right strategy and due diligence, you can mitigate risks and increase your chances of success. Working with experienced professionals, such as real estate agents and financial advisors, can provide valuable insights and guidance. Real estate can be a lucrative long-term investment. With patience, persistence, and a well-thought-out plan, you can build wealth brick by brick, creating a solid foundation for your financial future. Now let's dive into the world of mutual funds. Imagine a group of investors pooling their money together to buy a basket of stocks, bonds, or other assets. That's essentially what a mutual fund is. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. It's like having a personal chef who creates a delicious meal based on your dietary preferences. One of the biggest advantages of mutual funds is instant diversification. Instead of buying individual stocks or bonds, you're investing in a diversified portfolio with just one purchase. It's like ordering a pizza with all the toppings instead of just one. Mutual funds come in various flavors, catering to different risk tolerances and investment goals. There are stock funds, bond funds, balanced funds, and more. It's like choosing from a menu of investment options tailored to your taste. However, keep in mind that mutual funds typically come with fees and expenses. These fees are charged by the fund company for managing the fund and can eat into your returns. Finally, let's explore ETFs, or exchange-traded funds. ETFs are similar to mutual funds in that they offer instant diversification by investing in a basket of assets. However, there are some key differences. Unlike mutual funds, which are priced once a day, ETFs are traded on stock exchanges like individual stocks. This means their prices fluctuate throughout the day, just like the stocks they hold. ETFs are known for their flexibility and typically have lower fees compared to mutual funds. They offer investors a convenient way to access a wide range of asset classes, including stocks, bonds, commodities, and even real estate. Think of ETFs as the customizable sandwiches of the investment world. You can choose from a variety of pre-made options or create your own by selecting specific ETFs that align with your investment strategy. Just like with any investment, it's essential to do your research and understand the underlying holdings of an ETF before investing. Make sure the ETF's investment objectives align with your own financial goals. Thanks for watching. Remember, investing is a powerful tool to grow your wealth and achieve your financial goals. Whether you're saving for retirement, a down payment on a house, or simply want to grow your money, investing can help you get there. Stay informed, stay patient, and happy investing.